Well, hello everybody. This is Rob. Nice to be here with you. Okay. Now, I've got to say that I absolutely love to do sessions on the real world of trading. And let me tell you what I mean by that. Is that, look, there are hundreds of books, thousands of books. You could go out and get books on charts. You could get books on Elliott wave theory. You could get books on options pricing models. I mean, there are books out there with all of the information. And information is great. But what I mean is the real world of trading. The real world of trading, it's not out there. It's really not out there. And it's one of the things that I love to share with traders because this is what is going to make you successful or not. I've always said that, look, the market's going to do what the market's going to do. You can't change that. You can't do anything with it. Sometimes you're going to get it right. Sometimes you're going to get it wrong. The market is out there. You are the variable. We all know that in the market there's some people that make money and some people that lose money. It's the same market. It's the same stocks. It's the same thing. Some people make money. Some people don't. The difference is not about the technicals. The difference is the trader. The trader. One of the things that I wanted to work on with you in this session is dealing with slumps. Dealing with slumps. Now let's quickly go through slumps and losing streaks. And I'm going to go back to a baseball analogy. I think baseball is one of the best analogies for trading. One of the best analogies for trading. Now, look, in full disclosure, I'm not a huge baseball fan. I will watch Game 7 of a World Series if it's close. That's about it. I'm not a huge baseball fan. I remember playing baseball as a kid, and it was pretty boring, and probably because I wasn't very good at it too. But I remember being out in center field and purposely getting a bad jump on a ball just so I could dive for it and make it exciting. Obviously, my coach wasn't too happy. He could see that I could have got to the ball, but I wanted to make it exciting. So, but baseball again is it's a fantastic analogy of trading because baseball is a whole world of statistics. For any of you who've seen the movie Moneyball, Moneyball is such a fantastic movie, and it's based on real life where someone took a look at the numbers in baseball and they said, hey, this is how you win. You put these numbers together. Before that, everyone just thought, oh, you know what, you get some good players, you get them some bats, and you swing at it, and there was no recipe to success until, again, someone really broke down the statistics of it. Same thing in trading. Most people think, oh, you know what, I've got some capital, the markets are out there, let me go get a bat. Let me go get some players and see what happens. You've really got to understand the statistics. In baseball, we all know that you have a batting average. Your batting average is basically how many times, percentage-wise, do you get a hit. Now, if you get over 300, meaning it was actually, they call it 300 because they break it down to 3 decimal points, but really it's 0.3. We take a look at the actual batting average. When we say 300, it's basically 0.3. That means in baseball, if you get a hit 30% of the time, you are going to make it into the Hall of Fame. What does that mean? It means the other 70% of the time, you're either striking out, you're lining out, you're grounding out. Again, you're getting an out. Throughout players' careers, their batting average is going to fluctuate. They don't bat 300 every single time they get out to the plate. Every time they get up to a plate, it's a complete different at-bat. And sometimes during their career, they're on a hot streak. So again, baseball starts up in April. So let's say that a baseball player, the first couple months of the year, is batting 400. Now, there's been a couple of times in my lifetime where people, by the middle of the season, have been batting close to 400. The last person to do it, I believe, was Ted Williams, to finish the season over 400. There's been a couple of people in my lifetime that were there. What happened was, statistically speaking, they were trading, or they were batting above their average. Their long-term statistical average was 350. What inevitably happened was reversion to the mean. Reversion to the mean, and by the end of the season, they did not hit over 400. However, just like that, we're going to get it to swing the other way. There's going to be periods of the time where this batter, who is statistically a 300 hitter, they might hit 200 statistically. That might absolutely happen to them during an entire month, entire 2 months. It's during those times where, again, we call that a slump. We call that a slump. They're not hitting the ball well. They're below their long-term average. This is part of baseball. And I hate to break it to you, this is also part of trading. You must understand and accept that losses are part of this business. They just are. Understand that you're going to be hot sometimes. Understand you're going to be cold sometimes. This is the business. There's no way around it. So the biggest thing I want everyone to understand is that as you are going out there and you're doing your analysis, you're making your trades, there's going to be some times that you think you're really smart. And then there's going to be some times that you think you're the dumbest person in the world. Guess what? You're neither. Sorry. To half of you, I just thought, who we all had high egos or high hopes for ourselves. I just told you, you're not the smartest person in the world. And all of a sudden, it's depressing. But the other half of us that are like, we're the dumbest people in the world. Hey, we're not that bad. We're not that bad. Ultimately, you're going to be at your long-term average. Where you are at the moment, it really kind of, again, all this stuff goes into your ego. You know, when we're winning in trading, we feel great. We feel smart. We feel powerful. When we're losing, we feel stupid. We feel weak. We feel like we can't do anything right. Dealing with the emotions that come with that is a huge part of this business. And as I said, this is the real world of trading. This is the stuff that's not out there in books. This is the stuff that you have to, again, know a trader has been through it. You have to go through it yourself. This is the business. So let's talk about losing streaks. Again, losing streaks are going to happen. They're part of the business. The problem is they cause problems. They always cause problems. And it leads to lots of mistakes. Let's go back to our baseball analogy. Let's say there's a 300 batter. A guy that bats 300, he's done it for, let's say, 10 seasons. And at some point, he's in a slump. He's batting 200. Now, this batter, he's been swinging the bat the same way for 10 years. And in this moment, it's not working for him. Is this the time to throw away everything he's done in the past? To take on a new swing? To take on, some new stance? Or maybe he was batting right-handed. Is this time for him to stop batting right-handed and try his luck hitting left-handed? No, he's simply in a slump. He's simply in a slump. The best thing that batter can do is to make sure that he's not doing anything different and keep swinging like he has, because statistically speaking, it's going to swing back the other way. So that's really what I want to talk about in this session is, first of all, is that losing streaks are going to happen. I don't care how great you are. I don't care how smart you are. Losing streaks are part of this business. I want to make sure that when it does happen to you, and I'm sorry, it will happen to you, I want to make sure that you're ready for it, ready to deal with the emotions that come with it, and I want to make sure you don't make it worse. But the very first thing that we need to analyze when we're talking about a losing streak or a slump is, why is it happening? Why in the world is it happening? And I broke it down into two very, very simple options. It's either going to be one or the other. The first one is it's just statistics. We're going to jump into the statistics of slumps here in a second, and it's actually pretty cool. You're going to see the statistics are actually pretty mind-blowing when you take a look at them. Second reason is it's you. It's self-created. Again, going back to that baseball analogy. Maybe you're swinging the bat differently. Maybe you're using a different bat. Maybe you tried to bat left-handed for a while. Again, all these things, they can create slumps where a slump shouldn't be there. So again, the very first thing we need to determine, number one, is it just statistics? And if it's just statistics, we know what to do. And number two, is it self-created? Are you doing things differently? Are you breaking rules? Are you doing things differently? Are you trading different time frames? All these things we need to talk about. Most of the time I see a trader in a slump, it's self-created. Let me say that again. Most of the times I see a trader in a slump, it's self-created. We have to be very conscious of determining it. Now the first thing I want to take a look at is just the pure statistics. The pure statistics of slumps, just so you all understand that regardless of how good you are, how disciplined you are, how closely you follow your plan, slumps are still going to happen. If you make enough trades, you will experience a series of losses. And let me just give you a couple examples, and then I'm going to show you a chart. If you're watching this on a video, pause the chart, take a look at it. It's really interesting. Very, very interesting. All right, I have a question from Ray asking, what exactly constitutes a slump? Losing 5 trades in a row, 10 trades in a low, a lower win-loss than normal. There's no real technical definition of a slump, and a slump is different for everybody. Obviously, in baseball, a batter that bats 350 long term, if they're batting 300, for them that's a slump. For them, that's statistically below average. Whereas for a batter that's batting 280 in his career, if he's batting 300, he's actually not in a slump. He's actually swinging the bat really well at the moment. So there's really no absolute definition of a slump other than and again, I'm going to use the term long period of time. And I don't mean long period of time, but statistically meaningful enough of a period of time below your long-term average. That's going to be probably the best definition of a slump. All right, so let's take a look at the statistics, the mathematical statistics. If we took 3 traders with win-losses of 30%, 50%, and 70%, so that's what they say, 70%, and we had them make 100 trades, here is the statistical probabilities that somewhere during that 100 trades, they're going to lose 7 times in a row. They're going to have 7 trades in a row that don't work out. And I'm going to put up a chart here where you can actually get even more in depth and to see exactly what all the numbers are. But let's just look at 7 losing trades in a row. Well, a trader that has a 70% win-loss ratio, which is phenomenal, and that is a very, very strong one, they're going to experience a 7-trade losing streak 1% of the time. So that's not very statistically average. That's not very statistically significant, but they are going to have to deal with it every now and then. But let's take a look at a trader with a 50-50 win-loss ratio. They're going to have to deal with this slump 30% of the time. 30% of the time. So let's say that a 50-50 trader, they're not greater than 50-50, but they're likely to experience a 7-loss streak somewhere during those 100 trades. 30% of the time, they're going to have at least 7 losses in a row. all of a sudden now we're getting a little bit more significant. If we take a look at a 30% trader, a trader with a 30% win-loss ratio, it's almost a guarantee. It's almost a guarantee that they are going to have a slump. So I just wanted to show you some numbers, but here is the chart that, again, if you want to pause this, take a look at this. Up on the left side is your win-loss ratio. Win-loss ratio over here. And then this is the number of trades, losing trades. So if we take a trader that is 55% win-loss ratio, what's the statistical probability that they're going to have 4 losers in a row during the next 100 trades? 86%. So as you can see here, that's almost a guarantee. It's almost a guarantee. You can see a 50% trader with win-loss, it's even higher, 95% of the time. We go to the next one. What are the odds that they'll have 5 losers in a row, somewhere in that 100 trades? I mean, imagine you're making trade, you have 5 losers, 5 trades that just go against you. That's going to happen 76.8% of the time. That's almost a guarantee that it's going to happen. 6 trades in a row of a loss, it's 50-50. 50-50. So your odds are somewhere in those next 100 trades, you're likely to have 6 losers in a row. As you can see, as you go down the line, 7, 8, 9. So there's still an 8% chance that this trader is going to have 9 losing trades in a row. So this is where we really need to start thinking about worst case scenario. We need to start talking about drawdowns. Is that if you are in the situation where you potentially could have 9 losers in a row, if you are position sizing yourself for 15%, let's say you're way too aggressive, and you're saying that each trade you'll have 15% of risk on, when that happens, you're done. You're out. You're out of the game. You lost all your money. As you can see, if you have too big of a position size, the statistics of this say that at some point in your career you will lose all your money, even if you do everything correct. Even if you do it well, if your position sizes are too big, you will totally eliminate an entire account. So this is where, again, we talk about proper position sizing. We talk about the ability to take 5, 6, 7 losses in a row and not be out of the game. That's a huge deal. And that's why we focus on position sizing so much. I mean, imagine if, most traders, they over position size themselves. Imagine if they're risking 25% of their account, putting their entire account in 1 or 2 trades. Once they hit one of these statistic downturns, they're done. They're done. One of my favorite sayings in trading, and there's a playing in poker called all in. All in is when you bet all of your chips at once. And one of my favorite sayings in poker is that all in works every single time, but once. But once. And then you're out of the game. In trading, we have to be able to stay in the game. We have to be able to weather these storms. So I just wanted to point these out. If you want to take a look at these more, feel free to spend some more time on this. But you can see, the statistics are the statistics. You're likely to have a slump in there somewhere. Right now, I have a question about the difference between a slump and a drawdown. The term slump is definitely more of a slang term here. It's simply a collection of losing trades. Simply a collection of losing trades. So your drawdown is how much your account is going to go down when you have losses. So a drawdown is basically the amount of damage a slump does. The slump is just a period of time where your trades are not working out as well as you'd like. The drawdown is what is the actual damage to your account. All right, I wanted everyone to take a look at those statistics and understand that the statistics are there. Even if you do this perfect and you don't deviate from your plan, you follow your plan, you're still going to have slumps. But what I said earlier is that in my career, and again, I've been so blessed not only to be able to watch myself learn how to do this, but I've watched hundreds of other people trade. I feel like I have a very unique idea of what it takes to really trade well. Most of the people I've seen in slumps, it's self-created. Let's go through those, because that's the very first thing you need to determine. We've all been there. We've all been to where we couldn't, for the life of us, make a good trade to save our life. We've been there before. I've been there, Joe's been there, Corey's been there. Any trader that's traded any amount of trades has been there. The first thing we really need to do is we need to step back and really say, okay, I'm in a slump right now. Why am I in a slump? Take a look at your actions. Are you doing things differently than what you were doing before? These are the things that I've seen that are very common in creating slumps for yourself. Let's go through these. Personal issues, volatility, trading your opinion, and basically the wrong market conditions for your strategy. I want to go through these each individual because this video is going to be there not only just for everybody to see going into trading and know, hey, slumps are going to happen. What do I do when I deal with them? But I also want this video to be there when we have traders that are in a slump. Say, what is going on? I want them to be able to watch this video and say, okay, let's analyze everything. So the first one is personal issues. You must be in the right frame of mind and the right place in your life to trade successfully. I have seen this personally, and I have also seen this in our traders. I'm going to just share a couple stories with you, just so you understand how big of a deal this is. One of our best traders, he's been with us for a long time, all the way back in 2000, so very long time. When I first met him, I almost said his name, because again, this is kind of personal stuff, so I don't want. We'll just have a nameless person here. He was living on his own. Everything was great and doing very well. He had low expenses. He had everything paid for in cash, and he was able to trade just for the sake of trading. He got a call one day that his father had committed suicide. It was shortly after his mom had died, so his mom had died about 4 months earlier, and his dad couldn't take it. And so he had to go settle his dad's estate. And during that process, him and his two brothers got into a real nasty fight and battle. During that period of time, he was awful at trading. He was terrible at trading. And we finally talked, and he took some time off until it all resolved. When everything got resolved and everything's back, he came back, and he was the same trader that he was before. So again, nothing had changed as far as him as a trader, but what had changed is his mentality. He had all these problems around really taking his mind out of it. Another story over the years is that we had another trader. He'd been trading with us for about a year, had been doing pretty well, and then all of a sudden I started noticing some pretty erratic behavior in his account. And it wasn't like him. After we watch people trade for a while, we get a good idea of how they trade, what they trade, their risk tolerance. And this was very erratic, in and out and more like day trading and trying to scalp. And so I actually got on the phone and I said, hey. He's like, I know. I said, whoa. Let's don't worry about let's not talk about the trading. I said, what's going on with you? What's going on in your life? And he actually just started crying. And he's like, how did you know? He's like, I'm going through a really awful divorce right now. You know, my wife left, she took our kid with us, and I'm just having a hard time dealing with it. Again, same person, same strategy. What happened was the home life was an issue, and it was causing him to act differently. So whenever I see erratic behavior in a trader's account, that's the first thing that pops into my mind is, okay, there's obviously something has changed in their life. If I've been able to watch a trader do the same thing for a year, and all of a sudden they start acting wildly different, I know that there's problems. So in your life, you have to be in the right place. If you are trying to make your house payment this month off of your trading, it's going to be very difficult. If you have financial problems and you need to make $10,000 by the end of the month, don't try to trade. It is going to be very, very difficult. It's going to cause you to do the wrong things. Also, health problems. I've seen people deal with health problems where they aren't fully functioning. You know, their brain isn't quite working. You know, people going through something like chemotherapy where they're weak and they think, oh, I can still trade. You can't. You can't. You have to be in the right place. So, again, take a look at your personal life. You need to be in a good place. Your family needs to be in a good place. Finances need to be in a good place. Your health needs to be in a good place. If you have one of those issues, I highly, highly recommend you step back from trading. Look, the market's going to be there in the future. I always tell people this, if you have the right mindset where you're going to do this forever, and I always tell people, they are going to have to pry the mouse out of my dead hand for me to stop trading. I'm never going to retire from trading, ever. I will trade as long as I can possibly trade. I love it. But the market will always be there. Make sure that your capital will be there as well. Take a step back for a month. Big deal. If you're taking a look at a 20-year career in this business and you've got to step back for a month to let things settle down in your life, it's a no-brainer. Step back and then come back when you're ready. So again, first thing to look at is you. Look at your personal issues. Are you different? Are you in a different spot? Are you stressed out? Are you trying to make money quickly and instead of letting trades develop? All of those things are going to lead you to make wrong decisions that's going to cause you to have losses. All right, next one. Next one to take a look at, volatility. Now this is also a very common one. Very common one. And what I see is that people who are using very tight position management, and I'm going to use the word stops. Let's say you buy a stock at 50 and you put in a stop at $49.70. Or you have basically very tight position management to where if things go against you, you get out very quickly. During a low volatility environment, that might work very well. In a high volatility environment, that's actually going to be terrible. It's going to be terrible. And so what happens is you have 10 trades, you set up 10 trades with very, very tight stops or very tight position management. You get volatility, what happens? All 10 get knocked out. Bulls, bears, sideways stuff, they all get knocked out. Not because of the trade was bad, but because of the volatility got outside of your ranges. It's very easy to see someone with 10 trades with very tight stops get knocked out of all 10. And so this volatility is typically a real big one that I see as well. And it's people that have employed very tight position management strategies in low volatility periods. The market changes to a high volatility period and they take loss after loss after loss after loss. All right, so let's talk about how to manage this. And again, just a couple more things I want to go over. In our summit in Chicago a couple years ago, we actually looked at this exact issue here. We looked at basically two different stocks, one low volatility stock, one high volatility stock, and we actually ran all the numbers statistically that said, in the next 5 days, we took two stocks that were trading at 50 bucks. One was high volatility, one was low volatility. And I think we put in a stop at like 48 bucks. 48 bucks was our stop on both. But again, one was low volatility, one was high. And we showed the statistical probability of being stopped out in the next 5 days. The low volatility one was about 25%. The high volatility one, if I remember correctly, was like 78%. We talked about how this volatility, when you have these stops in place. So if someone was consistently buying a stock at 50, putting in a stop at 48, and they were high volatility trades, the stock was very volatile or the market was very volatile at the period, you could see how this statistical number is going to lead them into a slump. They're going to be wrong on 8 out of 10. They're going to lose money on 8 out of 10. This is a very, very common one. So it's one of the reasons we really talk about when our option strategies is finding, first of all, the right trades for the strategy and finding the right strategy for the underlying stock. So one of the reasons why in our trader room sessions, I always talk about, hey, this one's higher volatility. I'm only going to play this one through a vertical spread that I position size for max loss. Why? Because I know that it's going to have big swings. I know that. If I employ a strategy where I have stops in, I'm basically flushing my money down the toilet. And again, I've taken traders and shown them the trades they're making are like 78% chance, 85% chance of being knocked out in 5 days with a loss. When I finally show them the numbers, they say, oh my gosh, I thought I was just stupid. And I said, well, you're not stupid, you're just not understanding volatility. So, possible solutions of volatility. So, number one, don't use stops. All right, now, I don't want anyone to take this as don't use position management. I don't want anyone to take this as, oh, so we just let our losses run? No, do not take that in any way, shape, or form as that's what I'm saying. What I'm saying is don't use those hard stops. Don't use orders that say if it goes below 48, then get me out of the whole thing. What you need to do is you need to use strategies that allow you to sit through volatility. One of the things we talk about, again, let me just go through a very simple strategy here. Let's say somebody, there's a stock at 50, and they have a stop in at 49. 49 is their stop. So basically, they're willing to risk $1. And they think it could go up to, let's say, 52. Let's say they're going to sell it at 52, or they're going to sell it at 49. Why would you not just do a vertical spread, a 49-52 vertical spread? Again, and I know I'm jumping ahead here, but where your risk was $1 and your reward was $2. If you could put together an options trade where your risk was $1, again, your risk is the same thing. Same thing as the stock. Your stock had $1 risk, your option has $1 risk. Your stock has $2 of upside, your option has $2 of upside. But what this allows you to do is that if this stock plunges all the way down to 48, the strategy with the stop order gets stopped out at a loss. A loss of $1. The vertical spread, however, you can sit in it. This thing could go down to 40. Guess what? You don't care. You could still be in it. And then it rebounds back up, and by the end of the month it closes at 53. Guess what? You have a winning trade. You were able to sit through volatility. So volatility is the number one thing I think that kills most amateurs, is because they're using stops, they're using tight position management. Start learning different strategies to deal with this volatility. Another way to cut down or to limit this is to cut down your position sizes. So what I mean by that is that, if a trader said, I only want to lose $500 per trade. All right. And again, I'm going to use a stock example because it's very simple. But again, let's take that stock at 50. Let's say they put in their stop at 49. So basically they're willing to lose a buck. So their position size would be 500 shares. That's what their position size would be, 500 shares. Well, but if they couldn't cut down their position size, let's say they still want to maintain $500. Now, we do this in our FX side all the time. This is what everything is based off of. Let's say you say, you know what, I think volatility is going to be a lot bigger than expected. I think 48.9 is too tight for my stop. What if I put in a stop at 58? Well, now I simply have 250 shares. I cut down my position size. Let's say, you know what, I want my stop to be all the way down at 46. Well, now your position size simply adjusts down to 125 shares. Do you see, by taking smaller position sizes, you can give yourself a lot more room with stop orders? Now, I know I used a stock example, but there are some trades, like a diagonal spread, something like a leap right, something where you do still want to have a stop on it. Cut down your position size, lower that stop down. You're going to go from being stopped out 78% of the time down to 18% of the time. Now, yes, I know it's a smaller position size. You might have to do 2 or 3 different trades in order to get the same exposure you want, but you're very unlikely to be stopped out on volatility. And then the last one, if you're just not good at dealing with volatility, sit it out. Sit it out. There are some strategies, and again, I'm going to talk about this when we get into the wrong market. There's some strategies that just don't work well in rising volatility. If that's the only thing you do, and again, I do have some traders, and I've seen traders that they only do short volatility trades. When volatility is rising, I tell them, just don't trade. Just go away. Go away. Look, volatility spikes. Things get crazy in the market for a month or two. Just sit it out. If you're only going to do short volatility trades, just sit those periods out. They happen once a year, once every 18 months. Just sit it out. It's not a big deal. Look at your whole career. That'll help you out. Not overreact. All right, next one I want to talk about, trading your opinion. All right, this is another one that I see quite a bit. And this is one that I used to be guilty of quite a bit. Now, I say used to be because, again, I used to think I was smart. I used to think I knew. I always say that when I first started trading, my first trades, I literally had no idea what was going to happen. Once I started reading, learning, studying charts, learning about stochastics and Fibonacci lines, all of a sudden, I started to know what was going to happen. I started to know that this stock was going to go from 50 to 52. Guess what? I didn't know. Sometimes I did, sometimes I didn't. But the problem is the fact that I knew it was going to happen, when it didn't happen, I would tell myself, you know you're right. You just got to hold on through this loss. And it caused me to make some really, really poor trades and lose a lot of money. I no longer know. I don't know anything. Whenever I have a trader tell me they know what's going to happen, like, oh, I know this one's going to bounce at 20. I always say the same thing, and I won't say here, but I always say, you don't know blank. You don't know blank. It's not, you don't know it's going to bounce at 20. You think it will, but you don't know. Trading your opinion is a very, very dangerous thing in this business. And trading your opinion typically goes hand in hand with counter trend trading. Usually I always see where the market has been in a long bull market, and I'll have traders that say, oh, I know this market's going to crash. So what do? They go out and start doing lots of bearish trades right in the face of a bull market. It's very easy to have 8 losers in a row when you have 8 shorts in a row and the market goes up 10%. It's very easy to have a slump in that situation. Or, hey, I know that this sector is going to do this. You don't know. You don't know blank. Trading your opinion is a very, very dangerous game. Now, it's ironic in the fact that we have to do our research and build a premise of why we think something is going to go up or down. But whether it actually does it, you don't know. I don't know. No one knows. So what you really need to do is throw away your bias. It's why we have a saying at Maverick: trade the market in front of you. Don't trade the market you want it to be. Don't trade the market you think it should be. Just trade the market in front of you. Stick with the trends. You've all seen throughout your trading careers and your trading lives, when you've watched the markets, the stuff that's hot now is most likely going to be hot next week. The stuff that's cold now is most likely going to be cold next week. Yes, there are trend changes inside markets. There are periods of time where the oil and gas sector goes down and down and down, and at some point it will start going up and up and up. We know that there are trend changes. But again, these last for 6 months. These last for 1 to 2 years. Again, these are long trends that we might be wrong once in there during that trend change. But how many times did we right on the downside? Again, if we're constantly shorting, we're going to be wrong down here. We're going to take a loss. But then we analyze the trend. It's going up. Again, even if you think oil is likely to go down, let's say you think that energy is the worst thing in the world, but the trend is up. Guess what? The trend is correct. And if you are buying during that uptrend, you're going to make money. Trade the market in front of you. Get rid of your opinion. One of the things I see, again, that creates slumps is people trying to trade their beliefs. And it's funny because their beliefs are always tied up into politics. They're always tied up into books they've read. You know, the worst thing in the world, and this is, my mom is great. You know, my mom and dad, I'm the only one really in the, well, my brother's in the trading business as well, but not like me. So whenever my parents, or even my neighbors, hear anything, they always come to me. And my mom came to me with this doom and gloom newsletter she had. It was called the Stansberry Report. And I'm sure some of you have heard of the Stansberry Report. And it was doom and gloom. Now this was during the middle of a huge bull market run. And the doom and gloom was that the stock market was going to collapse like it did in 2008, that the dollar was going to be worthless, and the only thing that was going to be good was gold and silver. And my mom read it, and she's like, oh my gosh, we need to buy gold and silver. And I said, Mom, you know who wrote this? You know what these guys sell? They sell gold and silver. So of course they're going to be writing these doom and gloom pieces because it fits in with their objectives. I said, look at the market. Stocks are the place to be. Gold and silver are not. Since then, gold and silver have gone down 20%, and the market has gone up another 30%. So a lot of times you read things, you hear things. It's all fun for what I call cocktail talk. But when it comes to trading, trade the market. Trade the market. We will continually remind you of this. So if you are in a slump and you're watching this, take a look at your bias. Are you trading the market in front of you, or are you trading the market you think it should be? If you are, stop it. Just trade with the trends. Throw away your ego. Throw away whatever you think you saw or read. Just throw it all away. Trade relative strength and weakness. Right, the last thing that I see that causes people to be into slumps is that it's just the wrong market conditions. And this is very, very key for people that trade singular strategies. Now, we do have some traders that trade singular strategies. What I mean by that is they only do this. They sell condors on the SPX. They sell condors on the spiders. That's all they do. Now, it's a good strategy some of the time. It's a short volatility strategy. And I would say through most of the year, volatility is flat or going lower. However, there are periods of time where that strategy is a huge loser. And you could do it over and over and over again and lose every single time. Why? It's the wrong market for the current market conditions. It's why at Maverick we teach our traders multiple strategies. Multiple strategies. So by having a combination of different strategies working, you're no longer susceptible to this. So for example, let's say you have some long volatility trades, some short volatility trades, and let's say volatility spikes. Guess what? You're not going to see all of your trades lose. Some are going to benefit from the spike in volatility. You're not going to get 8 losers in a row. If you have 8 trades on that are all short volatility and volatility spikes, you will have 8 losses. It'll be a slump. You'll be like, why can't I make a right trade? It's because you basically didn't have any diversification. So the first thing you need to do is I would highly recommend that you learn multiple strategies and you employ multiple strategies and hedge yourself out. It's what we talk about all the time is that, hey, if we're long over here, we're short over here. If you've got lots of sideways trades over here, you need to probably add some directional trades over here. Make sure that you have that portfolio working. Again, we talk about not being too concentrated. I'll have people say, but Rob, I'm in 12 different positions. Yeah, but they're all bullish. They're all bullish positions. And you're in 3 different, all of them are concentrated into 3 different sectors. If those sectors go down, you're going to lose all your trades. All your trades. Be diversified, move things around, have some things working. Understand and identify which market conditions are not conducive to your trades. So this is really going into any traders out there that use singular strategies. Hey, I only do vertical spreads. Okay, look, vertical spreads, they work better in some market conditions than others. I'm only going to do sideways trades. I'm only going to do butterflies. Look, butterflies work well in some market conditions and they're terrible in other market conditions. You need to understand that a butterfly does not work well in rising high volatility. And if you see that market condition, oh my gosh, we have rising high volatility, don't do those trades. Do the trades that fit that outlook. Now again, we don't know what's going to happen. We may think volatility is going to rise. But remember I talked about trading your opinion. We have to have a premise. We have to put our trades in there. But we can't load the boat on that. We still have to understand, what if volatility doesn't spike? Do I have some trades working that are going to hedge that out? So again, combination of different strategies is really the best way to handle this. Have different things working over different time frames. So if you're wrong in the short term, you'll be right in the longer term. It's a better way to, again, cut down on those periods of slumps. Because if you do the same thing every single time, once a certain market condition hits, you're going to have a long string of losses and it's going to be a slump. All right. Hopefully everybody has seen that consistency is the key, and we preach that here at Maverick, and we're going to keep preaching it, is that we don't know. And it's so funny because I love when people find out, what do you do for a living? You know, how long you been doing it for? I've been doing it for like 20 years. Where's the market going? I don't know. Where's this stock going? I don't know. I have no idea. Now look, I can give you my opinion of where it's going, but I don't know where it's going. I don't know. My trades are based on probabilities and risk reward. Not because I know Apple's going to go to 150. I don't know that. No one knows that. But I talk to people all the time that they know it, And then when it doesn't happen, they take big losses. All of my trading is based on numbers. I don't know if Apple's going to 150. I think it is. I'm going to do this to capture some of that move, and I'm willing to risk this much in case I'm wrong. That's trading. Being consistent. We talked about slumps. Most of the time are from not being consistent. Things change. So we talked about number one, family and personal issues. Things have changed. You've changed what you're doing. Number two, the market changes. You had low volatility. You only trade low volatility strategy. High volatility hits. The market changed. You weren't able to, you didn't have a strategy in place that dealt with that. And number three, we trade our opinion. We're no longer trading the market. We're guessing. We're guessing. Now look, we're always guessing, but again, we're guessing with sound principles of statistics and risk reward behind it. We're not guessing saying, hey, I know this is going to do this, or I know we're going up right now, but I know we're going to turn down somewhere in the next couple of months. You don't know. You don't know. Stay consistent. Attack this thing the same way every single time. I'm going to put out 20 trades a month. 10 are going to be bullish, 10 are going to be bearish. Out of this, 5 of them are going to be vertical spreads, 5 of them are going to be horizontal spreads. Again, to where you do the same thing every single time, all of a sudden, everything's going to smooth out. Everything's going to smooth out. By doing this, you create consistency. You reduce those emotional decisions. You're no longer up and down on emotions. You're doing the same thing. You now create balance. It creates a balance. And again, I put last, exposes strengths and weaknesses. If you're doing the same thing every time, you get to really focus in on, hey, these are the things I do well as a trader. And these are the things I don't do well. And if you don't put yourself in the situation where you can screw it up, real quickly here, I just started coaching high school football on a volunteer basis. It's been really fun, but it's been a huge commitment of time. We'll see. I just barely started it. And just yesterday, I had one of my DBs, I'm a DB coach, one of my DBs go up and do bump and run coverage. What that means is you get up right on the receiver and you try to bump them and prevent them from going downfield to run a route. He got burned pretty easily. He got burned really easily. And so I grabbed him and I said, hey, do you think you're really good at bump and run coverage? And he said, oh no, I'm terrible. And I said, well then don't do it. Why would you put yourself in a position where you're doing something that you know you're not good at? And I said, look, just work on it. Once you get good at it, you can do it. But if you're not good at it, don't do it. And it made me laugh because we put ourselves in that situation all the time. If you know you're not good at trading high volatility, don't put yourself in that situation. If you know you're not good at sticking with a plan or sticking with a stop, let's say you've decided to use stops and you know that you're not good at keeping them in, don't put yourself in that decision. Don't put yourself there. Put yourself in positions where you can use your strengths and not your weaknesses. And this is it. Consistency. Consistency. Create your plan. Follow your plan. Look at it. Is it statistics? Is it statistics or is it something else? Because what we need to think about is survivability. And this is how I want to end this session. Survivability. I promise you, I absolutely promise you, and I wish I didn't have to do this, but we're real here. I promise you that at some point, you're going to have a losing streak. At some point, the market is going to test you. At that moment, it's all about survivability. You must survive to make another trade. One of the sayings that I've used a couple times with our traders over the years, that I've got a trader that has a concentrated position, they've blown everything, and I asked them this question: is this the hill you want to die on? Is this it? Is this trade? Is this trade in Apple that you got in with the intentions of only holding it for a day and getting out? That was their intention. I'm going to buy Apple at 118 and sell it at 120. Now it's at 110. And they've doubled up, they've tripled up. And I say, is this the hill you want to die on? Is this it? This is the stand you're going to make. Either you're going to live or die on this hill. And they always say, no. But that's what they're doing. And I said, look, get out. Get out of the trade, make it back somewhere else. Make it back somewhere else. You have to survive these slumps. Survivability is huge because, again, they will challenge you. And think about it. If you take 8 losses in a row, you will see a drawdown in your account. You will. You might see a 20-25% drawdown in your account. You have to be able to survive that. That's why we really focus on position sizing. Position sizing is the key to survivability. If your position sizing too large and just one of these statistical losing streaks happen or a self-created losing streak happen, you've got to be able to survive that. You've got to be able to survive that. So that position sizing is so critical. To survive these losing streaks, you must have a plan. Position sizing, position sizing, position sizing. You must be able to take 8 losses in a row without crippling your ability to make your next trade. So important for that position sizing. All right, let's wrap this up. Losing streaks are part of the business. I wish I could wave a magic wand and say our traders, we're so smart, we're so good, it's not going to happen to us. It is. We have to understand it's statistically unavoidable. We need to understand that during those moments we will be challenged. Our trading plan will be challenged, our ego will be challenged, our intelligence will be challenged. You're going to feel like an idiot, you're going to feel like crap, you're going to be low. You need to understand that at those points, that's when that consistency is even more important. Don't start swinging the bat differently. Don't be a right-handed hitter and right in the middle of your slump you decide to switch over to be a left-handed hitter. Stick with your plan. This is the one thing that's going to allow you to survive. At some point in trading, it's not about winning. It's about surviving. I want you to remember that. When you're at a point where you're starting to see the cracks, you've had a long streak, your account is down, and you start to see yourself getting desperate, wanting to make trades you wouldn't usually have made, I want you to remember to survive. Don't blow it at those moments. Take some time off, take a step back, stick with your plan, stay consistent. At those moments, it's all about surviving, not about winning. All right, thanks for joining me, everyone. Dealing with slumps, never a fun thing, but again, it's part of the business. This is real. This is stuff that's not in books. You've got to learn how to deal with it. Look at your actions. Are you creating the slump? If you're not creating the slump, trust in your plan, trust in your system, and just keep going. Reversion to the mean works on traders as well. If you're low, you'll be high in a little bit. If you're high, you'll be low in a little bit. That's how this business works. All right, thanks everyone. See you later.